Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. During the past few months, many people have fled coronavirus hotspots or their primary home to perhaps work remotely in another state or location or shelter in place with family or friends outside of the more densely packed communities. But the clock is ticking when it comes to whether they are considered residents of that location. And if so, they might be dealing with some complicated tax factors. Joining me to help make sense of these complications is Scott Ahroni, tax attorney and partner at Robinson Brog. Scott, it's great to have you with us. Welcome to Trade Talks.
Great to be here. Thank you for having me, Joe.
And Scott, U.S. tax code is complicated enough, and this adds a whole new element for many taxpayers. What does it mean to be a statutory resident, and which IRS codes and federal laws govern that status?
Okay, so the statutory resident is a type of resident under the Internal Revenue Code, Section 7701, and all residents of the United States are unfortunately taxed on their worldwide income. So if you become a statutory resident, which generally looks at how many days you're in the United States in a given year, as well as the 2 previous years, you could potentially be subject to tax on income earned here, France, England, etc. So it comes as a big surprise to a lot of people.
Okay, so there's a lot of people who, let's say, live in New York for half the year and Florida the other half of the year. Does that impact what happens internally as well? Because Florida, as we all know, doesn't have state tax, and of course, New York has some of the highest. Does it impact within the states as well?
Yeah, I'm so happy you brought that up because I think the residency issues, and from a business standpoint, they don't call it residence, they call it nexus. So from these perspectives, having employees sheltering in place in different locations than they're normally used to, as well as for businesses making sales to locations that they're not normally making sales to because they have people there, can create some substantial tax impact that a business is not normally used to. So, yeah, go ahead.
No, I'm sorry, finish your thought.
No, so for example, to answer your question, if you have the resident that is typically here in New York that is now living down in Florida, a lot of times they may think to themselves, okay, well, now I'm down in Florida, I don't have to pay New York tax. Unfortunately, that's probably not the case. They probably do have to still pay New York tax because they haven't properly disconnected. We've also seen instances where people actually disconnected, let's say in January and February down into Florida, but then had to come back to New York to take care of a loved one. And while they thought they disconnected properly, their presence back into New York afterward may have jeopardized their disconnection in the first place. So.
Got it. Okay, so let's talk about how these day counts, what they're called, impact people who left their primary residences due to COVID-19. What's that process look like? So let's say I left on March 13th, which is the last day I was at the MarketSite studio, and I decided I wanted to go to another state. Do you start counting, let's say Saturday, March 14th? And then who do you let know if you want to make sure that your tax status is okay?
Okay, so for day counts, you would start the next day. This is generally how day counts work. Any day that you're in the United States or in a particular state, because most states have a statutory residency rule, 1 second is a day. So you don't have to sleep in the state for it to be a day. You don't have to be there for a certain number of hours. I like to make the joke to my class when I'm teaching that if you went to the boundary line and you dipped your toe into the water from New York to New Jersey, you're in New Jersey for a day, and then you took your toe back out. So every second counts. However, there are certain exceptions, and the big one here is the medical exception. And when it comes to COVID-19, that's what's really the name of the game is this medical exception. So New York has an exemption for medical days spent in New York due to a medical illness. COVID would obviously count. So if you're in New York, you're sheltering in place due to a COVID quarantine, those days would not count against you in your 183-day test. The United States has an even better rule. They say that if you're in the United States due to COVID, whether you have it or just a fear for leaving the United States, we are actually going to allow you to exempt up to 60 days of the year to not be included in your day count.
Got it. Okay. Well, I'm glad you're a teacher because I have so many questions. It's such a fascinating subject. So what's your best advice on next steps, and what should people be asking their tax attorney at this time if they're concerned about status?
Okay, so here's the 2 things. Number one, individuals and businesses need to realize that they may be in places that they're not normally in. So what you want to be telling your tax attorneys and your accountants is, hey, I'm now located in Florida. What is my tax exposure by sitting in Florida, both from an income tax standpoint, a payroll tax standpoint, a sales tax standpoint? I think if we start from the premise that one employee's presence in a state that that business is not normally in can create exposure to every single tax across the board, I think it maybe puts some people on alert that there's a lot to be done here. And businesses can be significantly impacted years down the road when they get a bill from Nevada, asserting all this sales tax, and they say, well, we've never been in Nevada. And oh, wait, no, you did have one worker telecommuting in Nevada during this COVID period, which then created this necessary nexus requirement. And now that business is subject to a whole host of tax that they didn't realize. So I'd go out, I'd get in touch with your advisor this year, sooner rather than later, and say, hey, we're selling product into different states. Our employees are in different states. What is our exposure?
So then, all right, let's use Nasdaq as an example. We, to the best of my knowledge, don't have an office in, let's say, Alabama, right? So if somebody has been working from their family's home in Alabama for the past 6 months, does that mean, like, whether it's Nasdaq or any other larger corporation, their tax department or has to reevaluate what this looks like, since they technically have people working in states where we might not have had telecommuters or offices before?
Absolutely. So take
Wow.
Nasdaq, for example, right? So Nasdaq thinks that their worker, let's say, is in New York, but they're really in Alabama. So what does Nasdaq do? Well, Nasdaq does a few things. Nasdaq is withholding income, right, under New York law. Well, maybe they shouldn't be. Maybe they should be withholding income under Alabama law. And they may find out that Alabama treats that worker as creating a presence for Nasdaq in Alabama, therefore triggering the Alabama payroll tax obligation, not the New York payroll tax obligation. Now, of course, you may have an instance, because the United States, while we're all separate states, we do each have separate taxing jurisdictions, where Alabama and New York are trying to pull on the same dollar. And I think that's something that needs to be addressed. And federal legislation has been presented that would attempt to address this, but right now things are being done on a very ad hoc basis, state by state. New York has not commented, by the way, on any of this stuff. So New York has not said whether one worker in New York would create nexus for payroll, sales tax, income tax. New York is one of the biggest states where we need them to comment on how they're going to be treating these businesses. So to answer your question, yes, you can have every state pulling at the same dollar for Nasdaq from a payroll standpoint. Now let's take sales tax. Nasdaq, I don't know, is engaging in sales tax activities, but that one worker in Alabama could create nexus for sales tax purposes. And now every single sale that Nasdaq is making worldwide in the United States could be subject to sales tax. So that's problematic. And then income tax follows the same way.
Wow. Well, and you wanted to be a tax attorney. No, just kidding. There's so much to know and so much to understand. That's one thing that certainly never occurred to me through this pandemic. It was great having you with us, Scott. Appreciate the insight.
Thank you so much, Joe. Appreciate it.
And thanks for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.